Hello and welcome to Chapter 13. As Wartburg has gone completely online for the rest of this semester, I'll be posting videos every week for the chapters that we're covering. Thankfully, we're close to the end of the semester, so you should only have to endure this change in instruction for a couple of weeks. I hope everybody gets through this okay, and I hope everything returns to normal soon. Chapter 13 is about budgeting, and then we're also going to cover Chapter 16 and Chapter 17, which are looking at variance analysis of budgets. So budgets, part of the planning process. It's a financial plan of how we expect to meet our goals. So we have an operation budget, which is what we will be looking at. And the operation budget is part of our yearly plan where we set goals for the organization. We have goals for sales budgets and goals for production that we want to hit these goals, and sometimes we want to see a certain amount of growth from year to year in our sales and etc. So our overall plan, a master budget, includes the operations budget, the budget plan, and then it also has strategic information about the company and will include a capital budget, which we will get to in a later chapter. So we have a human element in budgeting, and this is because often in budgeting we create expectations. So we want to be able to hit our goals, especially if our performance evaluation is based on our ability to hit those goals. So we might do low and easily attainable goals in our budgets. We might make really easy to hit targets instead of creating any stretch goals that might motivate our employees to hit them. We want budgets to motivate our employees. We don't want it to be a form of discouragement. And that often happens if we set our budget goals too high. So if a company sets their budget goals so high that no matter how much employees work, they can never hit them, employees start to get discouraged and they'll stop trying to hit those budget goals. They say, well, we never hit them anyway. Why should I try now? There are multiple different kinds of budgeting. So one is called participative budgeting. So this is budgeting that uses input from all ranges of employees within the company. This helps to make people feel like they are involved in the budget, gives them a sense of ownership, and makes it more likely that they're going to be interested in engaging in productivity and things that help the budget. So our operations budget always starts with a sales budget. In order to make a sales budget, we have to forecast our sales. We have many different ways to forecast sales. So we can use sales staff, market research, Delphi technique, trend analysis, and econometric models. So salespeople have the best information about how our company operates. So historically, forecasting by using our current sales staff is the most popular and typically the most accurate type of sales forecasting. However, we can have a human factor issue in that they might want to set those low, easily attainable goals, because if they meet their goals, then that might affect their performance evaluation, their budget. We can also do market research. The nice thing is that with market research, we don't have this bias from people within the company. We just have information that we gained from our market research. We might also find new markets that we haven't previously gone into. The Delphi technique is where we have a forecasting group that submits individual forecasts anonymously, and then they come together not knowing who submitted what budget plan and try to find similarities and fix the differences within their budget plan until they get a budget plan they all agree on. This also helps to remove bias. They can also use trend analysis. So we've done trend analysis in accounting. If you're a finance major, you've also done various forms of trend analysis. We sometimes look at trend analysis in economics also, but this is where we use historical information in a way to forecast what our future sales are. This is a purely mathematical formula, and there's no human bias in that. We can also use models. So we use a regression model based on our past information. We have software available to perform the calculations. However, as I said earlier, we found that just sales personnel intuition is better at predicting our forecasted sales than any type of mathematical model that has currently been invented. Some of that is because those people just know the company and they get to know how it's going to perform. After we have the sales budget, we create a production budget. So we find out how much we need to produce each month in order to have enough on hand, enough stock on hand to meet our sales goals. So we take our units in beginning inventory, add what's required to be budgeted, subtract our budgeted sales, and that gives us our ending units in inventory. We are going to create a budget as an example. We then have the production cost budgets. Once we've determined how many units we need to produce, then we look at how many do we need of the direct materials required for production, what is the cost of those direct materials, how many hours of labor do we need, what is the cost of that labor, and how much manufacturing overhead would be applied to those production based on activity-based costing or a predetermined overhead rate. Additional budgets within the operating budget are a cost of goods sold budget, marketing and administrative budgets, budgeted financial statements for the income statement and the balance sheet. These are also called pro forma financial statements, and the cash budget. So the cash budget looks at cash payments and cash receipts that we expect to occur based on accounts receivable turnover policies, what our sales are predicted for each month, and other different policies we have for collection of accounts receivable, etc. Then we have our cash disbursements, such as our materials purchases that we take out of the materials budget, labor costs that we take from the direct labor budget, and then any period costs that we have on a regular monthly basis, our fixed regular costs that we have, any capital budgeting that we've had planned, and then we can predict what our income taxes might be based on our budgeted income. So as I said, when we assemble the master budget for a manufacturing firm, we start with the sales forecast. From that sales forecast, we build a production budget. The production budget is used for our direct materials, direct labor, and overhead budgets. Then we can use information from our production budgets, from our sales forecast, and a marketing and administrative cost budgets to create a budgeted income statement. From there, we develop a cash budget, and with that cash budget, we can create a budgeted balance sheet. With a retail organization, we just have to time our purchases of inventory to meet our sales. So that is different than the manufacturing because we're not actually producing anything. We don't have all of the production budgets, we just have the purchases budget for the plan of how much inventory we need to have on hand to meet our sales forecast. And for a service organization, we have our budgeted cost of services as our plan. And this is because as we're selling a service, we don't have any inventory or production. So we would just have labor costs or the cost of performing those services. There can be ethical problems in budgets. So some of the ethical problems we talked about at the beginning, where managers might be incentivized to create easy budgets or to lower their expectations in order to make sure they meet their budgets for performance evaluation. So that's where companies can try to encourage unbiased budgeting by making performance evaluation based on a lot of different things. Another problem in budgeting is if a company has a use it or lose it budgeting. So use it or lose it budgeting is common, especially in government and nonprofit entities, where you get a set budget for a year, and anything that isn't used at the end of the year you have to return, and your next year's budget will be reduced by that amount. Because of this incentivizes companies to make sure that they spend it all, even if that means buying a bunch of frivolous supplies and stuff when we get to the end of the fiscal year and we find that we're going to have an extra budget that we don't want to lose, we don't want to return, we don't want our budget to be cut, so we'll just buy a whole bunch of supplies and equipment to make sure that we use up that budget. We can also do flexible budgets. We do our sensitivity analysis or our what if analysis. So what if our sales forecast changed? What if our direct materials cost goes up? So we can use Excel and other kinds of accounting software to create budgets exploring different scenarios. So we can see the different kinds of fluctuations that might occur in our net income under different circumstances and various changes. Okay. So that is chapter 13. The next video is going to be walking through the creation of a master budget, and then chapter 16 and 17 will have separate videos.